So that's why we've seen, for example, in the past year, money supply is creeping up again.
The question that I kind of have, are we really in this easing cycle? Is it a given? And then also, how would it be different from previous cycles?
Yeah, good question. I think there's a couple moving parts there. If you think this is like 2008, you're going to be shocked. I don't really expect an explosive 2025. I think liquidity conditions are not like this big vertical like liquidity party, but I do think that
Lyn Alden is a top-tier investment strategist and best-selling author of Broken Money, where she unpacks the evolution of money through technology.
With her unique blend of electrical engineering expertise and deep financial knowledge, she delivers actionable insights to over 100,000 investors every month, helping them build wealth and achieve financial freedom.
In this higher rate environment, where you have sluggish private sector lending growth, offset by pretty big deficits, it's kind of choppy, and you really want to own them.
As you said it yourself, there's this meme, nothing can stop this train. Maybe there is something that could kind of slow down this train.
To your question of can we grow out of it, partially you could if you had something that dramatically reduced it. And so that's obviously something that as an investor you want to avoid. When it comes to investing, you always want to ask the question, am I...
Hey guys, so I'm back with another episode of Less Noise, More Signal. Today I'm very, very honored to have a really cool guest on the show, somebody that I have been meaning to talk to for quite some time. It's no other than Lyn Alden. Lynn, thanks a lot for coming onto the show.
Thanks for having me. Happy to be here.
Yeah, cool. Well, generally, I would say you would need no introduction because so many people know you and for what you do. But maybe because I have a few people from Swiss TradFi or something, who might not be that familiar with you. If you could quickly introduce yourself and what you do, that would certainly help. Yeah.
Sure. So my name's Lyn Alden. My background is engineering initially. Then I shifted more into finance and management of an engineering facility. But, in addition to all that, I had a lifelong interest in investing. It was kind of my first passion, even before engineering. And eventually, I kind of returned to the investing world. So I provide research for a large variety of investors, ranging from retail to institutional investors at lynalden.com. And I'm also a general partner at Ego Death Capital, and I'm involved to varying degrees in the startup world to provide board work, capital, advisory services to help younger companies accelerate.
Okay, great. Yeah, that's probably also within the Bitcoin space, right? Or is it uniquely within the Bitcoin space or
my
other
venture work
industries as well?
Yeah, my research work spans traditional stocks, bonds, macro, digital assets, commodities, kind of a discretionary macro analysis. There are certain areas that I tend to focus on, and Bitcoin is one of my focuses. In the venture side of things, I'm, Ego Death Capital and myself are very focused on Bitcoin. It can tangentially touch things like stable coins and a little bit into the broader space, but it's heavily focused on Bitcoin.
Cool. Yeah, great. Yeah, that's kind of what struck me, because you're somebody who I would say understands Bitcoin quite well, but then you also have probably one of the sharpest understanding of the entire fiat system and the financial system as a whole, and that just makes it a really interesting blend. And that's why I really wanted to talk to you. And maybe to start off, I would like to give this necessary context, because I'm also working in the investment world. I have friends who have been talking to me, and everyone needs to be doing investment nowadays. It's investing is on everybody's mind. I think you have written an excellent book just recently, Broken Money, where you kind of elaborate why this is so, why people have to think about investment, even though sometimes they don't like to because they have other things to do, And that really kind of what I feel when I talk to my friends, everyone is looking for the next big thing. And then obviously people are looking to these sort of mega trends, where they say, well, what is going to happen in the future? So there's renewable energy, AI, and all these other things, that people kind of tend to gravitate towards. And I think there's also some sort of Bitcoin framework that you can use here, So if I think of an obvious mega trend when it comes to Bitcoin, I keep coming back to this monetary debasement through debt monetization. And I think you have written on this extensively as well. So, I feel like there's this really high probability that government deficits will keep on growing, leading to the ever greater need for governments to debase their currencies and service this deficit. And although there is the possibility that like economic productivity could kind of increase exponentially and we could outgrow this deficit, it doesn't feel so likely. So after I've talked so much, I would like to ask you, do you agree with this analysis? And then, is it really that like debt monetization or debt monetary debasement is a sort of mega trade that we can kind of place Bitcoin into?
I do. It's been probably the biggest part of my macro work has been to analyze the impact of U.S. deficits and arguing that we're kind of exiting this, say, 40-year period of monetary dominance, and then we're entering this period of fiscal dominance. And there's various starting points you can kind of point to. I think 2019 is the part where I would say we kind of entered fiscal dominance, but it really became more apparent in 2020 and thereafter, more visibly explosive in that sense. And basically what that's starting to say is that fiscal deficit in the United States, and of course that has global implications, but fiscal deficit in the United States are larger in a given year than the amount of new bank loan creation, for example. And even in many cases larger than the sum of bank loan creation and net corporate bond issuance. And so, in other words, the stock of public debt increases faster than the stock of private debt, at least most of the measurable forms that we can track. Whereas in prior decades, it wasn't even really close outside of maybe a brief recessionary environment. So the fact that that's happening during non-recessions or during periods of low unemployment is relevant. You can look at like a 70-year chart of fiscal deficits as a percentage of GDP and unemployment, and they're very correlated. But ever since around 2017 or so, 2016, 2017, they started to decouple. And there's a variety of reasons for that related to demographics and other issues. But now we're kind of in this more structurally high fiscal deficit environment, and that has a variety of investing implications. It's basically more nominally GDP and inflationary intensive. So I was a big. I argued heavily that inflation was coming starting around 2020, and then it impacted. And then even after that major inflation cycle, is behind us, it still has ongoing ramifications when they're running 6 or 7% GDP deficits during economic expansion with low unemployment and really little room to cut most of those things. And I generally argue that the U.S. has a tougher time than other countries cutting this because they're so financialized. There's like a negative feedback loop where tax receipts in the U.S. are more correlated with asset prices, and especially equity prices, but asset prices in general, more so than many other developed countries. And therefore, attempts at austerity that have any sort of negative impact on the stock market tend to ironically feed back into lower tax receipts and make that austerity and deficit reduction very hard to do. So I think that we're locked in a pretty strong cycle here.
Okay, I see. Yeah, that's so interesting. But maybe coming back to what you said about 2016, 2017, where you think it kind of changed, and obviously like the pandemic then accelerated this. So you already said like it's due to demographics and some other reasons. Why did it change exactly at that time? And what was the regime before that now we're in fiscal dominance sort of regime, if we can call it that. So what was it prior to this, and why did it shift?
So the prior regime was monetary dominance, which is to say that the rate of bank lending and overall private sector debt creation is generally a bigger force in most years on the economy than fiscal deficits, with, again, exceptions for, the year after a recession or during or after. And so monitoring the business cycle and what the Fed's doing and that kind of thing were all very important parts of macro analysis. And what happened starting in the mid-2010s, so starting in like the 2016 period or so, is that the baby boomer generation started to enter their retirement years. And so it's a very large generation in the U.S. and elsewhere. And so retirement systems started to get top heavy at an accelerating rate. That's probably the single biggest variable for like why then did it matter. And that continues. So we continue to have an increasingly top heavy entitlement system where the number of people receiving benefits, whether it's Social Security or Medicare, is very large compared to the number of people paying in compared to ratios of decades ago. So that's number one. Number two is that we had 40 years of rising public debt to GDP. So we kind of bottomed in that metric in like the late 70s or so. You started to rise debt to GDP for about 4 decades, going from 30% of GDP to over 120% GDP. But that was offset by structurally falling interest rates for those 40 years. And really kind of starting in the 2010s, there wasn't really much lower to go. We already went to zero on like the short end, and the long end was at pretty low levels. And you don't really have that offset anymore. And so by the time they started raising rates at the end of that 2010 cycle, and then especially as they've raised rates in the post 2020 environment, that made interest expense actually start to mean something again for the first time in a very long time. And it's when you raise interest rates at a time when public debts are 30% of GDP. So as you go back to the 70s, most of the money creation was happening from bank lending. Deficits were there, but they weren't as big as the amount of money being created from bank lending. And debt to GDP was only 30%. So if you raise rates really high, you slow down that bank lending by a bigger amount than you blow out the deficit. Whereas if you fast forward to the current environment and debt to GDP is 120%, so you have a bigger stock of interest-bearing debt that gets refinanced over time. And if you're in an environment of slower bank lending and larger structural deficits, the source of inflation, or at least the majority source of inflation, is not from excessive bank lending and private sector credit creation. It's from large fiscal deficits that keep pouring into the economy. And so when they raise rates, it does slow down bank lending, but it actually blows out the deficit by an even bigger number than it slows down bank lending. And so inflation becomes stickier, harder to fight, has more consequences when they try to fight it. And some of the tools that we normally associate with inflation, especially in the 70s, either work differently or in some cases work backwards. And Japan would be an example of a country that's even further into fiscal dominance, which is kind of like why they don't even try to raise rates when inflation becomes a problem.
Mm-hmm. Yeah, that's so well said. I mean, so interesting. The thing that you just laid out, because also in terms of, when it comes to then kind of how to measure these kind of things, I want to come back to this when we maybe quickly touch on the topic of liquidity also, because I think it makes a difference in terms of what regime are we in terms of how you measure this. But maybe first, if I refer back to my friends, like we have established that there is this fiscal dominance regime that we're in right now, and probably then we could argue it's a good thing to kind of own hard assets in such an environment, but then the people are like, okay, Bitcoin, yeah, is a hard asset, probably the hardest that there is, but then still they kind of don't, or I feel like they can't really wrap their head around like these terms like government deficits, debt monetization, monetary debasement. So can we kind of structure these and where they come in each of these and how they relate to each other?
Sure. I probably would approach that in 2 ways. The first way is to focus on the fact that the baseline for inflation is not zero, it's negative. And that's because generally, thanks to human progress and people iterating on past work and technology getting better, we get more efficient at producing goods and services over time, gradually. And so if you had, say, fixed money, you'd expect prices to go down, not stay flat. And so we're measuring inflation from what is kind of fundamentally a negative baseline. If you used to make shirts by hands, and now you have a big factory that can just churn out shirts really quickly, you'd expect the cost of those shirts to go down dramatically rather than kind of stay the same. So if they're staying the same, which they kind of have been, then you're basically seeing that it's the debasement, the denominator itself is kind of offsetting that. We're having more supply of dollars, whatever currency you can think of, and that's kind of offsetting the structural price declines. So despite the fact that technology makes everything cheaper over time, or most things cheaper over time, outside of wars and other big setbacks of productivity, central banks have positive inflation targets. They want to have prices that go structurally up, despite the fact that technically prices should go down. And so they manage that by encouraging more money creation, either from bank lending or fiscal deficits that they can monetize. And so to your question of can we grow out of it? partially you could, if you had something that dramatically reduced the cost of energy and made energy way more abundant. Anything that massively increases productivity, like AI, offshoring and automation were the big productivity enhancers for the past few decades. That's why, for example, most of the inflation shows up in things like hospital services and childcare services and education, things that haven't really been automated that well yet, that actually require a lot of expensive domestic labor. Whereas anything that you can offshore, anything you can automate, ranging from electronics to software to shirts, that's not been very inflationary. In many cases, outright deflationary. And so you have that big mix there. So inflation's a spectrum based on how good we are at, improving it versus that structural background monetary debasement. And then that gets to the second point, which is, I think when it comes to investing, you always want to ask the question, am I being diluted? And if so, how and by how much? And so, for example, the money supply grows faster than CPI, usually. And that's because, again, the baseline for inflation is negative. And so if you have something like 7% annual money supply growth, which is what we've had in the U.S. for about 60 years on average, in developed worlds, generally pretty similar to that number. Emerging world, like developing countries, usually higher than that. So 7% money supply growth. If you have 4% annual productivity growth, you're going to get something like 3% CPI. And it's tricky depending on how you can tweak your basket for how you're measuring CPI. You can tweak around productivity, but basically that's how that gets broken up. And so even if productivity growth is high, and you're keeping up with CPI, you could still get diluted. Meaning that you're not investing as well as you could be, because you could be owning the scarcest, best things that are not diluting you or diluting you very little versus things that are diluting you a lot, but still managing to kind of partially maintain purchasing power. So, for example, if you hold bank accounts or government bonds that are paying you 4%, and yet money supply is growing by 7% per year, your share of the dollar network is shrinking every year. You're just getting slowly diluted over time. Now, of course, you can earn income and offset that, but it's like saving and melting ice cubes. The savings units themselves are getting diluted, and your active income is offsetting that. And so that's obviously something that, as an investor, you want to avoid. If your interest rate is lower than the growth rate of the thing, that's rough. So if you use gold as an example, gold in most forms pays you zero yield. But the average growth rate of estimated gold supply is something like 1.5% per year. So you do have a small dilution rate, but that dilution rate is pretty low, and it's generally lower than the productivity growth rate. So your amount of gold will generally buy you similar amounts or more amounts of goods and services over time, which is many people consider acceptable. If you look at something like Bitcoin, it has long term, it'll have zero supply growth. So you, in the long arc of time, fully diluted, zero dilution. Even now, the supply inflation rate is below that of gold, and will, because of the halvings, will asymptotically approach zero. And so that's kind of how you can think of dilution rates. And then when you look at, for example, the other factor to consider dilution, to finish that point, is market share. It's not just, you have to have something that's not just scarce, but is dominant for the thing that it does. So, for example, if you own IBM stock, right? IBM has been buying back its own shares. It's a deflationary asset. It's even scarcer than Bitcoin, right? The supply is going down, but IBM has structurally been losing market share in the whole tech infrastructure stack, and therefore your share of a segment of tech infrastructure, for example, is being diluted, even though your units of IBM are not being diluted, but IBM itself is being like pushed away by these other entities, and you're owning a piece of a shrinking pie. And so for Bitcoin to be successful, it not only has to be scarce, it's usage as a store of value, as what the things it aims to do, have to stay the same or go up over time. So generally, someone's bullish on Bitcoin, they think, one, it's a good network, it solves a problem, it's scarce, and then two, that I think that's going to continue taking market share, and that say 5 years from now, more people will be holding Bitcoin than they are today. And if that thesis holds, you probably should expect Bitcoin to do well, especially in the face of dollar debasement. And then same with gold. It's just that, gold is starting from a higher adoption base and does have some mild dilution going on.
Mm-hmm. Yeah, there's a lot to unpack there. So you just greatly, neatly explained, how it's all about these like relative differences also in terms of like dilution rate, in terms of supply, how it's structured. So that makes a lot of sense to me. The thing that I would push back on, or just would wonder, is like, and that's what I was alluding to with my first question, is kind of like, if you have Bitcoin and then you say, okay, what's the number one reason for people to buy it, And I was kind of keep coming back, as I said, to this monetary debasement through debt monetization. And if this is sort of a given, then I think it just makes sense to buy Bitcoin. And now my question is, and you alluded to this as well, like there is energy, something could be happening that just energy makes us so much more productive. I think you probably for sure, Jeff Booth, and he has this whole theory, that energy might be abundant at some point. And then also there's the AI revolution, that could make us a lot more productive as a society. So I'm really wondering, like, sometimes aren't Bitcoin a little bit too bullish on this argument? Yeah, and as you said it yourself, there's this meme where nothing can stop this train. Maybe there is something that could kind of slow down this train, because after all, deficits aren't carved in stone, if you know what I mean.
Yes, I think that the productivity growth doesn't really impact the deficits too much. What it affects is how inflationary those deficits are. If you have high deficits, but you have pretty low productivity growth, or even negative productivity growth, then those deficits are more likely to show up in inflation. Like if we're not doing a good job of gathering new energy and increasing our automation and making our supply chains more efficient, then that money supply growth over time is more likely to transfer into goods and services going up in price. On the other hand, if you have pretty significant productivity growth, then at least certain areas won't increase in price as much as you think, because it's offsetting the size of the deficits. But then there's the case that inflation is a spectrum. And so, for example, over the past 100 years, waterfront property has been very scarce, followed by fine art and gold, which are pretty scarce. And then there's things like oil, which we have gotten better at finding, but it's still fairly an energy-intensive and scarce process. And then you go down to soft agricultural products, grains and soybeans. They'd be very good at making more of over time. Things like electronics. And so you have this like spectrum. And if you're holding things like dollars or treasuries over the long period of time, the things where the productivity growth is coming from are probably not getting more expensive than you. Like $1 can literally buy you more television than it could 20 years ago. For a couple $100, you can get a decent television that's better than the television you could have gotten 20 years ago, because the productivity growth of making televisions has exceeded even the debasement rate of the dollar. Same thing for a lot of electronics and some textiles and things like that. On the other hand, if you were holding gold, then not only did you keep up with that, you can buy multiple TVs for the same amount, the same ounce of gold you could before. And Bitcoin's not been around for 20 years, but basically over time, if Bitcoin is successful at growing adoption and remaining scarce, then you could buy even more televisions. Basically, you still want to, no matter what productivity growth is relative to the fiscal deficit and debasement that's happening, you still don't want to hold the denominator that's diluting you. And instead, you want to hold the things that are scarce and attractive and that are at the top in their game, right? So, you want to own the big tech monopoly stocks, whatever the trends, like whatever is dominant, you want, and not heavily diluting its shareholders. That's what you want to own, or gold, or Bitcoin, or certain high quality real estate that you can. One of the best things about publicly traded companies and real estate is you can also attach a fiat currency short to it. You can attach a 30-year mortgage. So if the money supply is growing by 7% a year, there are people that took out 3% mortgages and you're on the right side of that. You're shorting the currency that's getting diluted, and you're buying a house which gets slowly diluted. It has maintenance and taxes. But you're kind of arbitraging that spread. And the same thing if you buy like a blue chip stock. Like why? Procter & Gamble's been around for like a century. They've been profitable for decades straight. Why do they have debt? Like they have billions of dollars in debt. And the answer is because they're arbitraging that. They're using that fiat currency short because they can issue, until recently, they could issue like bonds at 2% yields for 5, 10, 20 years. And they're shorting fiat currency against their more valuable equity and the assets that they own and the cash flows that they can increase prices on over time. And so basically the combination of owning fairly scarce things that maintain market share in their space and then either having and then shorting things that are rapidly increasing in supply and therefore not retaining their value.
Mm-hmm. Yeah, very interesting. Like shorting fiat. I mean, we know a few people who have been doing this for sure, and one of them obviously is Michael Saylor. But I mean, it's interesting because I think this is exactly how it's going to go in the future evermore. And probably because there's also so many people nowadays discussing like you want to do this indefinitely, so to say, short the denominator that's going down, but then maybe at some point also include within some type of TEP structure that you have, or loan structure include 10% of Bitcoin as well, and then you can additionally kind of, hold Bitcoin while you at the same time short the fiat and you still get the fiat loan, so to say. So I think this is something that we will probably increasingly see, and it's also being discussed. So, but maybe just this term debt monetization, I would quickly like to come back to, because I think you have written on this as well. And that is also when I talk to friends, I mean, they can't really fathom or wrap their head around what this really means, and what actually is debt monetization is, and then specifically in terms of like government debt, when do we speak of government debt being monetized? What's happening in the background, so to say?
So debt monetization occurs when the central bank and its broader commercial banking system are increasing the money supply to buy and hold a significant portion of government debt. And so if you have debt being issued and it's not being monetized, then you have what is effectively a crowding out effect, which is that, around the margins, it means that, if you're raising your deficits and you're not printing money to do it, then investors are having to absorb more of that issuance, which means they're buying government bonds and then they're not buying something else. Because most entities like asset managers and households are not particularly leveraged. And so when they buy something and they don't buy something else, that's a crowding out effect. That's a choice. And when they do that significantly enough, you get very levered. Like the amount of government debt relative to the size of the monetary base becomes very high. And that hit a peak in like 2008, where you had all very high public and private debts on a very thin monetary base. So way more claims for money than there actually are base unlevered dollars. And so their answer was, we'll just create a lot of dollars. And basically that is an anti-deflationary effect, because if you have a big debt, it starts to kind of implode on itself, then you start to get outright deflation pretty quickly, because you're literally when there's something like 50 claims for dollars, like total debt, like 50 claims for dollars for every $1 in the system. So it's like a game of musical chairs with 50 kids and one chair, and the music stopped, which is like calamity, right? So what they do is they start adding more chairs, and they don't have to add 49 more chairs. They just have to have enough chairs being added that it starts kind of like slowing down that process, and you get this like anti-deflationary force. So basically, you get an inflationary force on top of a, negative inflation force, and you kind of balance that out. And so, and then when you kind of fast forward to COVID, you have very large deficits. You don't really have things like bank failures or debt implosion, and so you just have large deficits going out to people. And instead of taking private sector money and kind of using that to buy the bonds and then redistribute it, it's just a lot of, half of it or so is just being printed. Basically, the central bank's just creating new base money and buying it through their intermediaries. And then they're also increasing liquidity of commercial banks that can then go out and buy it. And unlike household entities, they're levered 10 to 1. So when they buy government debt, they're not really crowding out themselves too much as long as the central bank has provided pretty liquid reserves. And so they can kind of just keep running deficits for a very long period of time and monetizing it. And the cost ends up being inflation, which again is it can show up as literally high inflation, or it's just showing up as inflation that's high relative to a negative baseline if there's a lot of productivity growth happening.
Mm-hmm. Yes, I see. Yeah, that makes total sense. I mean, what I was wondering, when we talk about these like deficits that you have also been alluding to, and then kind of like, that they will be probably kept on going, and the can will be kept on kicked down the road. So I was really wondering, could we say that it's almost a given that like the percentage of debt held by central banks like the Fed and then also like the respective central bank of each country, that it is also bound to grow and go up? Because I feel like I have these numbers that I looked up that in June 2024, I mean, the Federal Reserve held about like 14% of all US government debt. That was like almost double when it was in 2007, so like that was still like only at 8%, obviously during COVID or the pandemic, it was even up to like 22%, I think, in percentage wise. So it has come down, but like structurally over time, I feel like if we project this out and we kind of feel, okay, there's no way this train can be stopped. So it seems like a given that this should be growing ever more. And that, again, would then allude to more debt monetization, more monetary debasement, and again, water on the wheels of Bitcoin, I would say.
Yeah, I think structurally, it's set to go higher, higher highs and higher lows, up to a certain point. I would also include the broader banking system. So not just the central bank, it's also commercial banks. So for example, in World War II, when the U.S. was financing, that was the biggest deficits they ever had to finance relative to the size of GDP. And the Fed bought a lot of it. They increased their balance sheet by literally tenfold in 3 years. But then they also got the commercial banks to buy a lot of it. And ironically, when the central bank buys some of it, they create all these new bank reserves. So they add liquidity to the banking system. And then those banks can lever themselves up and buy a lot of government debt as well, and not have to worry too much about liquidity crises for the most part. So it's that broad central bank and its commercial bank arms that end up owning a lot of government debt during very high periods of public debt, and that's what we've seen recently. If you look at the percent of treasuries that banks owned going into the 2007-2008 crisis, it was very low. Treasuries as a percentage of their total assets was pretty low. And now it's notably higher. It's not quite back where it was in the 40s or 50s, but it's kind of the highest it's been since then. So the combination of the central bank and the commercial banks end up holding a pretty big chunk of public debt. Yeah, for sure. I mean, Michael Howell as well, right? And he's been arguing exactly that, like commercial banks have been joining in this debt monetization as well. But maybe I would like to hear your take there, because I was arguing or talking to some other guy, and he kind of understood that, like, if government is buying government bonds, then obviously, this is outright debt monetization. In terms of banks, he was kind of arguing, no, banks is kind of like the private market, it's even the money of the depositor, of us, the clients, ultimately, So this is like the private market buying these bonds. So it's not a type of debt monetization as if it were the central bank. So what do you think of this argument? Does it hold any water? Well, it's slightly different, but it's very similar. And from an investing standpoint, they tend to be very similar for liquidity. And that's because what they share in common is that there's no necessarily crowding out effect, which is to say that because banks are like levered 10 to 1 and their leverage can change over time, they're not necessarily not buying something else or not making a loan somewhere else because they're buying a certain amount of government debt. There's also the fact that they've been more regulated into owning government debt ever since the global financial crisis. So it's not entirely the private sector decisions. It's basically saying, here's regulations that effectively heavily incentivize or force you to own a bigger chunk of your assets in Treasury. So that's number one. And yeah, it's our deposits that are helping to fuel that, which means that, it diffuses the debasement out. So, the bank's getting debased, but they're okay because they're debasing their depositors. So at the end of the day, depositors are feeding the debts, and it's a form of deficit monetization. During the whole 2022 period and part of 2023, banks were not buying treasuries. They were effectively deleveraging, and that was pretty challenging for the treasury market to handle. Ever since around November 2023, they've been going back to treasury accumulation, and I think it's probably going to persist for quite a while. And that does have pro-liquidity effects on the market. And then importantly, whenever the banks kind of get stuffed too full of treasuries, like they run into certain liquidity issues or things like that, that's where, again, the Fed just steps in, and sometimes they can buy it themselves, or they can tweak bank rules and just let the banks buy more treasuries. So, for example, in September of 2019, there was the repo spike, and people thought it was a repo problem, but there's some analysts such as myself and Luke Groman and others that were like, it's not really a repo problem, it's a T-bill oversupply problem. And sure enough, so the first thing the Fed did was they jumped in, they started supporting the repo market. That was like putting out the immediate fire. But a lot of hedge funds and other entities were using repo to buy treasuries. And so a bunch of us were like, they're going to have to buy treasuries. It's not really a repo problem. That's just a surface issue. And sure enough, by mid-October, the Fed comes out and says, we're going to start buying T-bills. I know it looked like a repo problem, but here's the technical jargon, and we're going to start buying T-bills, but we're not going to call it QE because we're not buying long-duration treasuries, and the purpose isn't to stimulate, but we have to fix this plumbing issue by creating new bank reserves to buy T-bills because other pools of capital are kind of stuffed. Another thing is that during COVID, so in 2020, they were running into dislocations in the treasury market. So for a year, they excluded treasuries from the supplementary leverage ratio. Basically, it's made it easier for banks to hold treasuries for that year. And there's been ongoing discussions if they should make some of that permanent, that basically that would make banks able to absorb more treasuries. So when the Fed wants to monetize debt, there's a couple ways they can do it. They can just buy it. They can create new bank reserves and buy it themselves, which then liquefies the rest of the banking system, allows them to buy more treasuries over time too. Or they can tweak the rules to make it easier for other banks to buy treasuries. Or they can have these kind of permanent facilities, like standing repo facilities and reverse repo facilities, that increase the fungibility between treasuries and cash, which then enables banks to hold more treasuries because they know that they always have this kind of like open market to convert back to liquidity when they need it without necessarily having a realized loss. And so those tools are all kind of working in harmony to put less pressure on non-banks to have to buy all that debt. And it's some combination of the central bank and broader banking system.
Yeah, I feel like this rule book, is always the same, just like in different, maybe a little differently disguised, and then, but it's always like on the heart of it, or at the heart of it, it's the same. Because you have this we could even call it an acronym department at the Fed, who keeps on coming up with these new names for these facilities and programs, and they are maybe temporary at first, and then all of a sudden they become permanent. And it's been the same ever since, we all know it from the gold window, when this was canceled, this was also just temporary and never permanent, and we've never gone back to gold, so to say, as a system. But I mean, in terms of permanent, I would like to bring up this recent paper, which was, I think, published by some researcher at the Federal Reserve at Minneapolis, I think, and you tweeted about it as well, this unique implementation of permanent primary deficits, and I've only skimmed through it, and I had ChatGPT summarize a few of the things. I don't know if you have already read through it or what you make of this paper.
Yes, a part of it. It has actually been an interesting series of central bank reports that have mentioned Bitcoin. So the ECB had a report saying that basically if Bitcoin goes up a lot, then it benefits the holders and it punishes the non-holders or the late adopters. But that's true for any asset. I mean, when U.S. tech stocks added, 10 trillion in market cap over a decade, you want to be owning those. You didn't want to be the one not owning those. Same thing if Bitcoin goes up at size. So it's like, they argued before that Bitcoin is done as a bad investment, and then now they're shifting it to, if it's a good investment, then that's also bad because it means that those that don't own it are missing out, and that we should maybe curtail that. We should get all the non-Bitcoiners to help us in our politics against Bitcoiners, essentially. Yeah. And then this other paper basically argued that it's easier to run structurally forever government debts when alternatives are banned or heavily taxed or otherwise impaired, which is true. I mean, basically, when after World War II, I mean, a lot of the ways that governments solved the debt problem is they kind of just did capital controls, they banned gold, they forced entities and individuals to own debt, and then their purchasing power got partially transferred to the government to pay off the debt. And then the way that they can and this is where using debt strategically can be helpful. One of the sneaky things is that capital gains taxes are not inflation adjusted. So if you buy a house and it goes up by 7% a year, and money supply goes up by 7% per year, and then after 10 years you sell this house as an investment, you don't have to pay it. You might have made no net growth. You didn't really grow relative to the money supply. You just kept up with the money supply. But then now you owe a big chunk of taxes just for kind of keeping up with the money supply. So it's actually similar to by being diluted at the end of the day. And they can do that for gold. They can do that for Bitcoin. They can even target to go after assets higher than normal taxes. So if they particularly don't like an asset because it's the best one or something like that, it's giving them the most headaches. And so governments do tend to want to add frictions or costs or taxes to try to recoup the fact that some people are trying to escape the debasement. They want to impose debasement because they want to tax, they want to spend more than they tax, because that's popular. But then when there's obvious costs, or some people are better at escaping that than others, they want to try to then close those exit doors or offset those exit doors in various ways. And you see also, emerging markets sometimes do this with dollars. They don't want people owning dollars when they want them to own their own fiat currency, which is debasing even faster. And this is kind of a cycle as old as time, is to try to basically debase the money. It's kind of an invisible inflation tax on the population, and then try to obfuscate or block the exits. And it's funny that the Minneapolis paper just kind of outright mentioned it. It was pretty blunt about it. And there have been other ones. The Liquidation of Government Debt by Carmen Reinhardt. It was republished by the IMF, and they're literally just saying that normally you need a captive audience to own the devaluing debt, and they're just saying it. And then they explored what if we ban cash? Because if you ban cash, then you could do outright negative interest rates. And the problem is if cash is an option, you can't have negative 4% interest rates because people would just pull it out in cash. So then they're how can we do different schemes to this is back during the disinflationary 2010s. They were just kind of hey, if we wanted to have super negative interest rates, how can we make it harder for people to escape to cash, let alone escape to gold or Bitcoin or whatever. And this is where using some strategic debt can be helpful, as long as you don't get over your skis and get liquidated at the wrong time. Because on one hand, you're owning an asset, it's not being debased very much, but you're getting taxed on the inflation. So some of that's kind of still being put on there. But if you're shorting fiat currency, then your spread is pretty big. So if you own a house unlevered, it might not be an amazing investment after taxes and maintenance. But if you own a house with a very low fixed rate mortgage, then that's generally a better investment. And same thing for what MicroStrategy is doing with Bitcoin. They're issuing convertible debt. And it's not it's not like you get liquidated on a Sunday night. It's not that kind of leverage. That's kind of unwise kind of leverage. But it's like leverage that they can't just be called on a given time based on Bitcoin price. And so they structurally benefit from the thesis that Bitcoin will keep appreciating versus dollars.
Mm-hmm. I see. What is your personal feeling, when we because as you said, we have these people who come out and they outright kind of admit, how they're thinking. I remember also Christine Lagarde, a few years ago, I think she also kind of in one of these talks was pretty blunt about it, saying, Bitcoin is an escape wall for cryptos and we need to close these, So because nowadays, like a lot of Bitcoiners and people are also, government is fully against Bitcoin, obviously for obvious reasons. If you listen to Andreas Antonopoulos, his like talks from back in the day, he's also quite, hey guys, the final boss, he's not here yet. We're going to have to fight this war. There's no way around it. But then at the same time, especially in the last few months, we've seen especially some politicians in the US and then also some other people, they have been quite pro Bitcoin. And so I was wondering, in what way are the coins going to fall down? Is it more to the we're going to outright prohibit it? We're going to do it like a little candidly, or in the sense of that people won't recognize it, or we're going to embrace it outright, with some type of Bitcoin bill or something. So what is your gut feeling?
So I think the first key point is that governments are not monoliths. Unless you have an outright, fully centralized dictatorship, governments are not monoliths. They have a bunch of different interests within the government. And so, for example, when the United States banned gold in the 1930s, that was actually arguably the most centralized power the U.S. government ever got. The president won, and then he had a super majority in Congress. So him and his party could practically get around all checks and balances because the country became so collectivist at the time. Public opinion was very collectivist. And they could even potentially override the Supreme Court by stacking it when you have all the chips on one side of the table. So they could do pretty extreme things. I mean, they put people in internment camps based on their ethnicity. They went after journalists really hard. That was a very significant time.
Tough time to do.
And so one of the defenses against that kind of thing is to have enough polarity in government that it kind of gets in its own way. So one of the, right now in the U.S., the Republican Party embraces Bitcoin and crypto more than the Democratic Party, but it's not like 100 to 0. Generally speaking, the age of the politician really matters. So on average, younger politicians are more correlated with being in favor of the space. And my argument's been, okay, if you can get the majority of Republicans and then you can get a minority of Democrats to like the asset, then you can cut off the tail risk of having a supermajority against you. And that's part of why I write about Bitcoin so much, and part of why I wrote Broken Money is because education is part of the battle. If you can this ECB paper that says, hey, look at those Bitcoiners, they're getting rich on your behalf because they chose to buy an asset that you didn't choose to buy, and now we should go and ban it and make their lives hard. If you can make the case for why Bitcoin's good, why you should probably consider owning some, and why it's not some big threat to you. The way I put it is that if a decentralized spreadsheet is bad for the government or bad for the existing system, that says more about the government or the existing system than a decentralized spreadsheet. That's really all Bitcoin is. It's like a decentralized ledger that we're all kind of agreeing to use. If that's a gigantic risk for everything we built, then a lot of what we build is kind of a Ponzi, right? So I generally think that education is one of the most important things, and then relying on the fact that there are something like 200 jurisdictions in the world. So some populations and some governments are going to make it hard. But then there's other ones saying that they can arbitrage that. They can say, hey, look, if they're making your life hard over there, come here. We want your business. If you're wealthy and you own Bitcoin, you can come here and, just live here, and they can benefit from that. So there are these kind of hubs that then try to make use of the fact that there are other countries that are pretty successfully making it hard to operate there, either as an individual or business in the space.
Yeah, exactly. Yeah, that's pretty much my thoughts as well. I mean, it's well said. Well, I mean, I would like to shift gears a little and come to this last topic again, because we mentioned liquidity already, and I'd like to quickly, talk about this as well, So, you said liquidity is quite important, obviously financial liquidity, also in terms of what drives asset. I think you've written co-authored a recent paper also, or article where you kind of expanded on that topic. So what were your findings there?
Sure. Yeah, I partnered with Sam Callahan to do a research report on liquidity and its correlation with other assets. And there's multiple ways to define liquidity. We wanted one that was like reproducible and pretty easy to measure. So we picked global broad money supply denominated in dollars. And so there's two main variables that affect that. One is how much credit creation or monetized fiscal deficits are happening around the world. Those things tend to increase the broad money supply. And then two, how strong is the dollar relative to other major currencies, which is relevant because the majority of cross-border debts are denominated in dollars. And so when multiple countries have their currencies weaken relative to the dollar, that can be tricky for their cash flow situation or their overall liquidity situation. Because if you took out a house, if you owned a house in the U.S. and you took out a mortgage in Swiss francs, and then the Swiss franc doubles compared to the dollar, which means that generally your mortgage increased in value relative to the value of your house and then the cash flows that your house might produce if you're renting it out, you're impaired now. And that happens to a lot of countries with dollar-denominated debt. And so generally speaking, a weaker dollar or just more overall money creation tends to be pro-liquidity, kind of pro-debasement or pro-inflation in various ways, pro-asset inflation. And we generally found that some assets are more correlated with the rate of liquidity changes than others. Bitcoin was the highest on the list. It was the most directionally correlated with liquidity. So in any given 12-month period, Bitcoin would move in the direction of global liquidity 83% of the time, which was higher than other assets. Gold and stocks were also very high, whereas like bonds were pretty low correlation. And then we did other studies to say, well, if Bitcoin's only correlated with liquidity 83% of the time, what's happening the other 17% of the time? What are the other major drivers? And one of them was valuation. So one of the biggest catalysts for what can give you a 12-month period where Bitcoin goes in the opposite direction of liquidity tends to be when it's starting from a very high valuation. And we measured that in terms of market value to realized value, which is kind of on-chain cost basis. So when you have a really big bull run, the market value goes up a lot, but it's not necessarily a ton of coins trading hands. There's not necessarily a lot of volume locked in at those higher price levels. It's kind of like if you have a street with 20 houses on it and one of them sells for $50,000 more than it sold last year, all the houses on that street go up in estimated price, even though really only 5% of them traded hands, one out of 20. And the same thing happens to a less extreme scale with Bitcoin, that when you have a really big bull run, there's a fairly small amount of volume that's making the value of all coins higher. But some of that is kind of ephemeral. And then over time, generally speaking, you get a weakening of the market cap and you get a steadily increasing of the kind of the cost basis as more and more coins trade hands. And so generally buying in periods where you have that really big dislocation increases your odds of having a negative year despite positive liquidity. So by looking at both liquidity conditions and looking at relative valuations, that can generally help entities, have a reasonable view of what might happen over a given 12 to 24 month period with the asset.
Yeah, exactly. Yeah, I mean, the on-chain metrics that you mentioned, I think I had James on check on the podcast as well, and we kind of elaborated on these as well. So definitely very helpful. I mean, I read the paper as well, and I will surely linking in the show notes as well. One question that I would be having in terms of like the liquidity question or argument that you brought up is and this goes back or harkens back to the point we were talking about in the beginning, that we are now in a fiscal dominance regime where maybe bank lending is not the driving force anymore, in terms of deficit financing, and then also maybe in terms of financial liquidity. So if you still, I mean, that's what most people do. All the big corners, they take global M2, money supply, which, as I understand, is broad money supply, which again is then bank lending. So would you say that this metric is sort of impaired nowadays, or is it still just a great gauge to make out what's happening in terms of liquidity?
I still think it's a good metric because fiscal deficits that are bought by the central bank or the banking system still increase broad money. And back during the whole 2020 and 2021 period of rapid government stimulus, I was writing a series of articles to explain why what was happening now was different than 2008. So in 2008, even though there were some bigger deficits, because of the bank bailouts and stimulus and things like that, the deficits were not nearly as big as what we got in like 2020 and 2021 in the U.S. And they were going up against a destruction of a lot of loans. So there was, when loans are paid back or defaulted on, that destroys broad money. And so they had about as much deficits as they had loan losses. And they monetized the deficit. So you increase the monetary base a lot. And a lot of people at the time, especially in like gold enthusiasts and stuff, were saying this is going to be very inflationary. But it wasn't, because it didn't dramatically increase broad money supply. You increase base money supply, which I argue is anti-deflationary. It kind of prevented broad money supply from going down like it did in the 1930s, but it didn't make it go up rapidly. So you just had less deflation than you otherwise would have had, and you didn't really have a lot of inflation. On the other hand, in 2020 and 2021, when they did these massive deficits, despite the fact that there were just not a lot of loan losses, and then they monetized through the central bank and the banking system a lot of those deficits, that dramatically increased the broad money supply. Money supply jumped like 40% in 2 years. And so running at the time, like if you think this is like 2008, you're going to be shocked, because this is people there's more broad money. It's not just bank recapitalization, which doesn't really flow out into more nominal purchasing power. This is actually getting out. And so when we look at global M2, it's both bank lending and it's monetized fiscal deficits in various ways. And so that's why we've seen, for example, in the past year, money supply is creeping up again, even though you still have central bank quantitative tightening. And that's partially because commercial banks are buying the fiscal spending again. So that's pretty positive for M2. I mean, it's not great if you're holding dollars and treasuries, but if you're holding other assets, that's a case for it.
Yeah, exactly. I mean, yeah, you already said it now, like liquidity is like creeping up again. So maybe one of the last questions I would have is really like, if you are on X or Twitter again, most people are cheering that the liquidity cycle, or rather like the easing cycle is starting again, with the Fed that kind of pushed it off, and it seems to be going well, and the question that I kind of have, are we really in this easing cycle? Is it a given? And then also, how would it be different from previous cycles, or maybe is it different in the sense that, I mean, we have seen ever since the Fed has lowered interest rates, bond yields have spiked up, and now there's already talk again that maybe this easing cycle hasn't started. So I was wondering, is it just more volatile, but still there's going to be an easing cycle, or what do you make of it?
Yeah, good question. I think there's a couple moving parts there. One is that the deficits in the U.S. are likely to continue chopping along. There's even a case that they could narrow a little bit next year, because there's some tax cuts that are set to expire, and it depends on the election outcome and the congressional structure at the time to see how that resolves. But either way, they're not going to shrink dramatically, but they're either, they're going to chop around. And so there's this background deficits that are happening. Two is that we're probably going to get to the end of quantitative tightening next year by the Fed and certain other central banks. And it's not going to be because necessarily they want to stimulate, but it's going to be similar to September 2019, where there's some little liquidity pocket, and they have to go back to maintaining that ample floor of bank reserve liquidity, unless they want to do things like change the SLR rules or things like that. But that's also a form of liquidity easing. So they're going to have to, I think, pull a couple levers by the end of next year, and that probably means stopping quantitative tightening. Even if you look at the annual report that the Fed put out earlier this year, they even predicted that by the end of 2025, they'll probably go back to the end of quantitative tightening. And they describe it as like they chart out their expectations of keeping their balance sheet at a similar percentage of nominal GDP. So as GDP goes up, their central bank balance sheet goes up, and they're gradually monetizing some of the deficit, even though they wouldn't use that term. And it's not for the purpose of stimulus, but it's the purpose of not having bank reserves shrink relative to bank assets and relative to the size of everything else. So I do think that, by the end of the next year, we'll have that going on, which is a pro-liquidity move, and you could see that from other central banks. And then I think that, there are pockets of the U.S. economy that are slowing. And rate cuts are not very effective at addressing those for a couple of reasons. One is that so much debt is already locked in at lower rates anyway. So unless you're willing to cut all the way to zero, which I don't think is going to happen, it doesn't really encourage a lot of new refinancing and things like that. And two, as you pointed out, that sometimes when you cut the short end, the long end doesn't go down or goes up. And that's actually what a lot of people are borrowing at, is the longer end. And so I think that I don't really expect an explosive 2025. I think liquidity conditions are not like this big vertical liquidity party. But I do think that 2022 is a particularly bad year for liquidity. That was an awful year for liquidity. It stabilized in 2023 and 2024, gradually inching back up. And I think that 2025 is either continuing to gradually inch up or could inflect a little bit more quickly up. But I wouldn't necessarily expect fireworks. The other big variable to watch is China. It's not just the U.S. So China is another big variable. They have recently turned toward mild stimulus in terms of the value of the stimulus that they're doing. But I think it's an important signal that they're kind of drawing a red line under their current economy. So they're not necessarily trying to juice it up and pump the property bubble again, but they're slowing down the rate of deleveraging that's happening. And I think that's a pretty big turning point for impacts on liquidity. So I think you have a couple different variables coming together that may not give you an amazing liquidity environment. It might not be like 2017 or 2021. But I think it's better than, 2022 is awful. And I think it'll be equal or better than 2023 and 2024.
Yeah, that's pretty much my thoughts as well. Because the reason why I asked this question is also, as I said, I'm working as an investment manager, also looking at different digital assets as well. And then if you spend some time on X again, most people were like, okay, yes, there's going to be an easing cycle. And we're just going back to all the alts pumping like crazy, the everything bubble that we had in 2021 or maybe even 2017, as you said, which was a different period. And I kind of have the feeling this is really wishful thinking in the sense of people have seen Bitcoin dominance going up just relentlessly. And now they're really hoping for something, but it seems to be hopium because as you said, you might have some of these liquidity signals as you said, quantitative tightening that could be closed down. And then also out of China, some stimulus. But then again, there's deflationary tendencies out of China that are probably kind of there, and we don't have a negative real interest rate environment yet, as we maybe had, back in the days when everything was quote unquote pumping. So yeah, I kind of have the feeling that a lot of people will probably be disappointed by just suspecting that, especially in terms of digital assets, everything will just go through the roof again, right?
Yeah, I think it's important to focus on quality in this liquidity cycle because it's not like a fire hose of liquidity. It's probably just decent liquidity. And there's a couple reasons. One is, I don't really see an altcoin narrative right now. There was ICOs, there was DeFi, then there's NFTs. So unless someone can come up with the next big narrative, I think that's a headwind, right? I don't think meme coins are sufficient. And I think, real world assets are inherently kind of less speculative, so there might be little certain chains that capture certain market share or something, and it's a good trade, but I don't really see this really broad everything up type of environment. I think that around the margins, with Bitcoin, some of the things that are benefiting in it are liquidity is helping, but then in addition, I think what happened part of this year was the ETF pulled forward some of the demand. So people got really excited, it pulled forward demand. And then even though the ETF launches were successful, based on any kind of metric you could look at the success of an ETF launch, people were just overly enthused about it. And, going back to that MV, the market value to realized value or market value to cost basis trade, it got kind of heated back in March. And ever since then, even though the price itself, kind of chopped around, the cost basis kept increasing. So it went from 520 billion to almost 650 billion since March. which I think is good. It's putting kind of a higher floor under the price. And so we're getting cooled down in valuation. We're absorbing some of that initial enthusiasm and kind of putting that behind us. MicroStrategy is probably going to be a driver just because it's trading at a high premium. And so they're going to keep issuing securities to buy Bitcoin at a pretty meaningful percentage of what miners are selling to the market. And so I think this is a fairly institutional driven cycle for at least a little bit. Maybe retail shows up after we're at like all-time highs or 100K Bitcoin or whatever. But I think I'd be pretty skeptical of just indiscriminate assets going up. And another way of looking at this, I looked at like ARK, for example. ARK, ARK Invest, ARK Innovation ETF. They had, of course, their really big bubble in 2021. People would pay almost anything. And these stocks are generally lower quality, not to say it in a bad way, but they're mostly unprofitable tech stocks. So they're more speculative. They're generally pretty expensive, and you have to expect a lot out of them. Compared to like quality tech stocks would be like the big profitable monopoly titans. And what we've seen in after all that kind of rolled over in 2022, we've seen a resurgence of quality. So people are buying the big profitable tech stocks, and most of them are recovered their highs or exploded past their highs. In many cases, Bitcoin has been chopping back up near its highs compared to many other altcoins that are not near their highs. And ARK is in the bucket of nowhere near its highs. It's off of its lows, but it's kind of just chopping sideways because again, there's no indiscriminate liquidity. I want to buy everything. It's saying, okay, liquidity is not really getting worse anymore, and the spice is flowing. Like there is, banks are buying treasuries and money supply is inching up. And so, what around the margins do people want to buy? And the answer so far has been S&P 500, gold, Bitcoin, basically quality things is kind of been the answer. And I think it's probably it could broaden out a little bit into maybe more cyclical equities. And things like that. But I do think that in this higher rate environment, where you have sluggish private sector lending growth offset by pretty big deficits, it's kind of choppy, and you really want to own the highest quality stuff.
Mm-hmm. Yeah, quite an astute observation with ARK. I've been following this as well, and I had a similar feeling. Like it doesn't look like as if there was like an all-out liquidity flush or war coming back anytime soon, and this is certainly signaling this as well. Well, Lynn, thanks a lot. A lot of like high signal statements from you again. Thanks a lot. Maybe my last question is just, do you know any other high signal person that we should be talking to on this podcast and that you could recommend that you maybe even personally know? And
it's hard to say. I haven't seen your recent guest list. I mean, probably one that always comes to mind is Alex Gladstein. Because he kind of talks about the use of Bitcoin and stable coins and financial freedom technologies around the world with specific examples in environments where it really matters.
Sure. Yeah, that's I haven't talked to him, and maybe at some point I will. That is certainly a good recommendation. Yeah. Cool. Yeah, I think that's pretty much it. Thanks a lot, Lynn. Yeah, it was a very interesting conversation, and wish you all the best and hope to see you in person sometime soon at one event or something. Would be nice.
Thank you. You too.
Yeah, Lynn, thanks. Have a good one.